On Friday, we saw the worst day in the S&P in 2025 so far, but when we look at over the last year, not everything is as bad as it seems. Many companies are up very strong double digits. However, one company that hasn't performed that well is Pfizer, which is down around 5% over the last 12 months, whilst as we can see, even companies in the same category like AbbVie, like BMY, have performed at least positive and significantly better. Now taking a look at this company, we want to understand Pfizer trading near its 52-week low, offering a dividend yield near the 7% mark, with Quant giving this a strong buy and a double buy from Seeking Alpha and Wall Street. Is this one we should now consider in the portfolio, or are we looking at a very enticing but dividend trap? We can also see that over the last 10 years, this is down 22%, so actually you would have now less money than you initially invested in 2015, and this company has hit its all-time high, but we're talking about over 3 years ago at $60. One thing we want to bear in mind is that this company is facing quite a number of patents which are expiring over the next few years, and if we take a look at some of those in particular, we can see there are 4 of their largest ones, and the earliest expiration does sit at 2026, although we can see from analysts they believe the 2028 expiration of Eliquis could be one of the most painful for the company moving forwards. They in fact anticipate this, at least over the next few years, to grow at a 10% year-on-year point, which is very good for the company, especially given the fact their growth, at least over the last few years, has left a lot to be desired. And one way they are looking at this is the very typical putting a lot of money into research and development, but also looking to lower their costs. And one way they are helping to get over this is by doing a lot of cost cutting. As we can see, they're lowering their spending by $3.5 billion last year, and they're looking at an additional $1.7 billion over the next few years. They do, as you would expect, have a number of products that are coming in the pipeline, and they're hoping 2025 will stand for a lot of catalysts to help on these, which are very near their release production, as we can see up to 4 regulatory decisions. When we look at their latest earnings from a few weeks ago, we can see that they topped their earnings estimate, as well as a lot of cost cutting, something we just mentioned earlier. Now looking specifically at the numbers, it was a very significant beat, very impressive, 63 cents, well above the 46 anticipated by the market, but also the revenue looked very strong, 17.76 above the 17.36 forecasted. The company also said they're on track to deliver their overall net cost saving around $4.5 billion by the end of the year. And one thing investors will love to hear is that the chief financial officer talked about the revenue volatility being largely in the past, as a lot of their COVID-related uncertainties have effectively diminished. And one of the things they are focusing on based on a lot of this cost cutting is helping their ongoing margin expansion. We also noticed their bottom line looking very strong at $410 million for the latest quarter when you compare that to the same quarter last year, where they reported a net loss of $3.37 billion. And this quarter was also a very nice increase from the same quarter last year, as we mentioned, just under $18 billion, but this is up double digit 22% from the same quarter in 2024, and they also reiterated their full 2025 outlook. Now if we look at the historical performance of the company over the last 4 quarters, so ultimately all of 2024, they outperformed and quite significantly management targets, 100% track record, but important to understand over the next 4 quarters, they do anticipate 3 of them to be a decrease to the EPS year on year, and based on the earnings per share of around $3, the company does trade at a forward valuation of 8.9. Now we'll compare this to the sector, but first we want to touch upon 2 things. We'll touch upon the valuation very shortly, but it wasn't too long ago where in fact there was an advancement of RFK's nomination as the Health and Human Service Secretary, and just last week it was in fact confirmed, although very tightly by a 52-48 vote, that he is indeed confirmed for the position. Now investors do see this as a negative for Pfizer, but it wasn't too long ago in fact where the Pfizer CEO said he had developed a good relation with RFK Jr., and just at the beginning of this month he did talk about having dinner with RFK, saying he is cautiously optimistic in spite of his history with vaccines. So what we're going to do when we look at our own valuation later is add an element of margin of safety to incorporate all of the bearish news around the company. But in terms of valuation, they get an A+. The sector comparative does sit a lot higher at 19.25, meaning you're getting a 54% discount to the overall sector. Now, sometimes companies do deserve to be trading at a discount. Our job today is to understand whether or not the market has overpunished the company and if we're looking at a golden opportunity. But in terms of their own 5-year average, it sits lower than that at negative 20%, and something we are seeing no matter what valuation metric you look at today. Pfizer is trading not only lower than the sector median, but also lower than their own 5-year averages. In terms of growth, they get a C+. Now, year on year, 9%, higher than the sector at 7.6, although lower than their average of 15.8. Forward looking, 3%, lower than the sector at 7.3, but higher than the 5-year of 1.8. And over the next 3 to 5 years, one thing that does taint their overall rating is the EPS is only expected to grow at 2.6%, when it is lower, quite away than the sector at 10.5, but also lower than the historical averages of 3.5. It does look impressive on the profitability at an A+. Gross margin does look impressive, 74%, a lot better than the sector median at 59%, a lot better than their own 5-year of 69%, and bottom line looking impressive again at 13%, given the sector is burning through cash, negative 5%, but over the last 5 years, a bottom line net income has sat higher at the 21% mark. But one thing this company does very well is generate a significant amount of cash from operations, 11.3 billion, when the sector itself, again, losing money, negative 14. The only thing we would say is over the last 5 years, they have generated quite a significant amount more of cash, around 19 billion. But bear in mind, this will also include the COVID years, which was very strong for their overall business. Now, just a few slides from their own investor presentation, but when you do remove COVID products for the full year, their revenue was up around 12%. Nice to note, double digit, but also nice to see that was above their own expectations of 9 to 11%. And then the other thing that we really wanted to point out here is when we do look at their cost of sales in relation to revenue, it is actually significantly lower than the previous year, negative 18 percentage points. And what this ultimately means is from 2023 to 2024, they really improved significantly on their margins, something that we do anticipate to continue over the next few years while they are still incorporating this massive cost cut reduction plan. And one thing we always advise to any investors or potential investors, always look at how companies you're considering or investing in allocate their capital. With Pfizer, very nice slide, easy to understand. They've returned significant amounts to shareholder pockets, 9.5 billion to be exact through the dividend. They've delevered the balance sheet by paying around 8 billion. And as we mentioned at the beginning of the episode, with some of their patents coming to an end, they continue to reinvest heavily in R&D, research and development, around 10.8 billion. And one thing nice to see, they have incorporated, even though nothing has taken place in 2024, but no share repurchase at the moment for Pfizer. And then the final slide here is just the reaffirmance of the 2025 financial guidance, where they anticipate 61 to 64 billion for the full year. Other things we like to incorporate in our analysis is what the institutions are doing, with around 68% ownership, 9.5 billion worth of shares sold over the last year, so for 2024, but we do get a little bit more buying by the institutions at 12 billion, and also something that is consistent as well. In the most recent quarter, institutions were continuing to buy more shares, so you could see here institutions very clearly have been bullish on Pfizer, at least in 2024. In terms of insider ownership, 0.06%, so very low, but one thing we have noticed with no insider selling, we actually get insider buying of $527,000, and as we can see, that is in Q1 of this year, so very, very recent. In fact, it was the director on the 13th of February, so not long ago at all, buying just under 20,000 shares. As we can see, the cost $500,000. And this is what we would typically call a very bullish signal, as insiders buy because they believe the share price will go up, something we haven't seen for quite some time. Now, we did talk about this company at the beginning of the episode in terms of their poor performances, but when we compare them against others in the pharma space, Sanofi, BMY, Novartis, as well as others, we can see over the last year, it is pretty much flat. Whilst not great, it's not the worst performing in the industry. When we expand this to over the last 5 years, again, not great at all, it then becomes the worst performing, negative 1%. And over the last 10 years, we can in fact see, whilst a positive gain if you were reinvesting your dividends, massively underperforming the S&P. But again, remember, past performance has nothing to do with the future. Again, we'll show you so you can visualize it. The S&P has outperformed over the last year, and the same to be said over the last 5 and the last 10. Again, something to bear in mind is ultimately if you're picking an individual stock, it is because you believe it will outperform over the longer term. Now we're going to take a look at their underlying metrics, starting off with their dividend safety that comes in 75 safe. We'll cover these two undervaluations that both show severe signals, and we can point out they did increase their dividend just a few months ago at 2.4%. Not that great given that it does sit below the typical inflation guidance we want at around 4% at a bare minimum. Now last month it was reaffirmed dividend is safe, which means for Pfizer, at least for now, the dividend cut does look to be unlikely. Now we can also quickly see some of their key metrics. Now this is from the 07-09 recession. They actually cut the dividend. They had above average sales, -6%, S&P itself, -12%, and they marginally outperformed -45, S&P, -55. As we can see over the last 5 years as well, marginally below inflation at 3%, over the last 20 just above at 5% year on year, and in terms of increases, they have been increasing the dividend itself for the last 14 years on a consecutive basis. Now we get to the first valuation model, but do bear in mind we're not looking at any one of these models in pure isolation. And first thing to note is the blue tunnel, the expected price, has been increasing over time, but right now there is massive disparity between the current value and even the lower end of the expected intrinsic value. That is one signal today of severe undervaluation. The second one here is when we look at dividend yield theory, telling us a company is undervalued when the current yield sits above the 5-year. Massive disparity again, one of the highest yields they have offered over the last 5, and another undervaluation signal with the forward P sitting below the 5-year of 11.4, and as we highlighted earlier, in terms of the sector P, it does sit a lot higher for healthcare, coming in around 16. Now if we take a look at the first metric, the free cash flow payout, as always ignore the earnings because it is susceptible to manipulation by management through accounting. We want below 60%, just to give us faith they can at least offer dividend increases at least in line with inflation. Massive red flag in 2023, that is a triple digit free cash flow payout, meaning they paid out more in 2023 in dividends than they generated in free cash flow. The same to be said on a trailing 12 month. Nice to see over the next 12 months it is anticipated to come down to 59%, but definitely something we would say to keep an eye on. Then we move on to the free cash flow per share. Consistent growth over the long term is something we want, something we don't get. In fact, pretty much flat all the way to 2020. Then COVID happened and then it increased significantly. But then in 22 to 23, we see a massive drop based on a trailing 12 month, and over the next 12 months, it is anticipated to increase, but nowhere near the levels we did see around 21 and 22. This is also noticeable when we look at the sales growth, as we can see very, very inconsistent, very poor in fact up to 2020, and then we get a massive drop in 2023, although over the last full year, as we did see, there was a nice increase to the top line. Hopefully we can continue to see a little bit of consistency, and you can see it below on a numerical format. What they have done over the last 10 years is return excess cash through those share buybacks. It has decreased. Bear in mind, as we saw in that latest investor presentation, no shares were bought back in 2024. It remains to be seen if this will take place in 2025, but currently they're focused on paying a lot out as dividends, a small increase, and then we did also see paying down the debt and putting a lot of money into R&D, something expected from a company in this industry. ROIC 10% or more, give us faith management are able to effectively allocate their capital. Very inconsistent, but nice to note 10% in the most recent year. And then in terms of the margins, again, we get a lot of inconsistency. It is above 12%, at least for the majority of the last 10, 26% in 2024. And again, inconsistency, the same to be said on the free cash flow margin. Finally, net debt to EBITDA, number of years it would take the company to pay off all of their debt net of cash on hand. Below 3 is what we want. That is what we get on a trailing 12 month. As we saw, they are looking to pay down a lot of debt. Hopefully that continues. 2.14 over the next 12 months. That is a good sign. As we said, hopefully this is something they continue to focus on. Remember, this metric does correlate to dividend safety and balance sheet strength, so both of those, at least for the time being, do look to be okay. Now, before we jump into the valuation model, just to let you know, just minutes ago, we have released our latest free weekly article. We drop one every single Monday morning, completely free to your inbox, where we cover severely undervalued stocks, as well as what's going in the market over the last few days. Click below, you can sign up, read straight away, where you'll be able to gain access to 45 undervalued stocks for the month of February. And on top of that, you can grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into our valuation, which comes to $32, which is the average of these four models that you can see on screen. We'll run through each one very briefly. Graham's valuation, the stock ticker symbol PFE, with the inputs here giving us an intrinsic value of $24.25. We get our first overvaluation signal today, but bear in mind we're not looking at any of these models in pure isolation. Then the multiples valuation model, companies in a similar sector and size, the average P, the EPS giving us our intrinsic value, we get our first undervaluation signal. Then we get the dividend discount model with the average growth at 2.5%. Moving forwards, we've pretty much gone in line where we get another undervaluation signal at a value of $32. And then we get to the DCF model, free cash flow year on year, average growth 13%, we got a lot more conservative at 4. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, $33. Now remember, 31.52 is the average of these four, and you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Pfizer or any others. But we're not just done there, because we always add a margin of safety, 10% or more, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, in today's episode, a buy at around $28.37, and then we keep going till it's near the current trading price. Now, right now, for Pfizer, we see between 15 to 20% MOS. At 20, a buy around $25. At 25%, around $23.64. And for those looking at 30%, around the $22 mark. So right now, as we said, around the 15 to 20% level. Wall Street themselves, they do see upside, as we saw a buy rating, 19% over the next year. They see this company sitting in the $31 region. As always, give us your thoughts. Near a 7% yield, is this one you're looking to add? Maybe waiting for a further drop if you do anticipate this, or for whatever reason, it isn't one in your portfolio, it lacks growth, maybe you don't like the company overall, or maybe this is one you already hold. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join this in the Patreon where we cover our weekly buys and sells. We have been making buys and sells given the volatility over the last week, and as always, have a great day. We'll see you all on the next one.